Hey guys, long time no talk. I wanted to do a quick video on what I feel is going on, and I have a day off, so I felt that, hey, let's do another video. Anyways, guys, S&P around 2014, Dow is around 18,150. I haven't checked in the last 30 minutes, so it's almost the end of the day. 3 p.m. Eastern or 3 p.m. Central Time. Now, if you look at the stock market, right, it hasn't appreciated to the extent that we saw in 2013, 2009, 2010, after the Dow bottom in March 29. That's what I'm trying to say for the returns in 2009. But if you want to look at this year, it's been relatively flat, hasn't appreciated that much. Now, going into this election season, which has been really crazy, and you could say entertaining as well, and if you want to look at Hillary or Trump or whatever, it doesn't matter who wins, in my opinion, it's going to be very volatile, in my opinion. Why would I say that? Well, you've had 8 years of the stock market going up in a straight line, and now you have a new administration, and there's a lot of tension going on in Congress. Nothing gets done. Both parties won't get along. And because of that, you don't know how the policies are going to be next year. I mean, they say, I'm going to do this, I'm going to do that. Well, guess what? You have to deal with Congress. And Congress right now isn't made up of the best guys out there. Paul Ryan is a joke, in my opinion. So, if Clinton wins, we're going to see volatility. Trump wins, I expect the market to do Brexit 2.0. Because there are a lot of guys out there who are traders may think that, okay, system's rigged, Clinton's going to win. Just like with Brexit. Market went down hard. When S&P went to around like 198, 199, and then it went back up to like 218. So I expect something similar to that. And the reason is that it may be the knee-jerk reaction, but after this knee-jerk reaction, you have to look at the fundamental of the economy, right? You have interest rates still artificially low. You have to also look at the fact that despite all this insanity that the U.S. government is doing, right? The firms still, they're not having horrible profits. The profit margins, they're still beating earnings, but not to the extent that they were, you could say, 3-4 years back. They're not having great results compared to then. Now, if you want to look at, for instance, one metric I use, and it is the amount of taxes the U.S. government is receiving. Now, you could say, why are you looking at that? Well, I don't agree with the government statistics. They're rigged and whatnot. But one number that you cannot make up the amount of cash coming into the U.S. government, the amount of outlays going out of the U.S. government. You can't fabricate that. I mean, the taxes from a year-over-year basis has actually increased. So that tells me that most likely you won't see a stock market collapse like we saw in 2007, 2008 in the next few months. And then you have to also look at December. December usually is a strong month for cash receipts because companies hire part-time employees. Now, you have to look at the fact that in 2007, 2008, if you saw the tax receipts, they actually went down, and they started to go down significantly also in November of 2008, if you look at the numbers. I remember seeing May 2008, tax receipts started to go down. June 2008, tax receipts started to go down. And then you got into the Lehman time, October, tax receipts down. So this could be one indicator that I'm looking at carefully that, okay, the U.S. government's still getting the money from us hardworking citizens. So that being said, that's why I think after initial knee-jerk reaction, after Trump or Hillary wins, I still see the market going back to all-time highs, right? It doesn't warrant it. I mean, I would say that it doesn't warrant it based on how we see the anemic economy, but this is Wall Street's rigged game. And if they keep rates low for this long and we don't have the 1970s type inflation yet, then the market is going to go higher. Now, in terms of inflation, the dollar and whatnot, you see the Dixie right now, dollar index at 98, and I still see that dollar index will go higher. Well, in this trading environment, I don't know when it will go. Some people are saying it's going to break out now. What I can tell you is this. From a fundamental perspective, I've been saying this for 1.5 years. The Eurozone is a mess. What Merkel's doing is insane. And the ECB, Brussels, whatever. They're all crazy. And since 59% of the dollar index consists of the euro, guess what? The dollar index is going to go higher. And the British pound is 10%. Their currency is being pummeled, right? Knee-jerk reaction to Brexit. Japanese yen, not the strongest currency as well, and that's 10-11%. So you have 80% of the US dollar index going in the favor of the US dollar. So that means that the dollar index should go higher. That doesn't mean that it's time to load the boat on shorts at this moment. There will be better entries, in my opinion, to do that. We had a good opportunity at 1.17 if you were awake in the wee hours of the night. That's what happened that one night. I think that was the high of the euro at 1.17 this year. So let's put that into perspective. Now, in terms of gold, in my opinion, will be going sideways for now. I think what may make the gold price go up is election time, right? If you see Brexit 2.0 with Trump winning, you may see gold prices go higher for a week or so. But the ultimate trigger for gold, or the ultimate stimulus for gold, will be the next rate hike. If you remember last year, the price of gold went higher when Janet Yellen decided to raise the Fed funds rate. And you may be asking, why would gold prices go higher at that moment? Well, when you raise rates, as long as it's below the inflation rate, the real inflation rate, right, that's actually a stimulus for the economy. It sounds crazy, the craziest thing that you can imagine, but because of higher rates, fractional reserve lending and whatnot, and also when rates go higher, right, the U.S. government has to pay more interest payments. More interest payments means more deficits for the U.S. government and also more cash for people on hand. And you know the story, right? Fractional reserve lending, multiplier effect, and whatnot. So I'm looking at the price, the Fed funds rate, to go higher in December. As long as the market continues to rise, you will see Janet Yellen with the new administration. She will want to raise rates, right? She won't do it before the election, but after election, I wouldn't be surprised. The only way that we will not see a Fed funds rate hike is if you see a trade war break out between the countries, because Donald Trump he's not protectionist per se, but his words may be perceived as protectionist. So that's something to look out for. That's one reason why I may not see the rates go higher, but more likely than not, in my opinion, rates will go higher, and they're going to raise the rates once this year. It's not going to be a big rate, but it will be a stimulus, in my opinion, to the price of gold and silver. But we should watch out. But if they do that, the dollar index will sell off at that time. And there will still be better opportunities to short the US dollar. Just waiting for the bounce in the euro and then go from there. And the reason why I say that is because the Eurozone is a mess, right? If the Eurozone decided to fix its own mess, then guess what? I think I would do the opposite, short the US dollar. But we shall see. So in this difficult trade environment for many investors, right, if you know how to play volatility, you will make money. And I feel that those individuals who are selling premium, right, and they're good at selling premium, or they know how to trade these options, selling these options, selling out of the money puts, selling deep out of the money puts. Those individuals, in my opinion, they're going to do well in this environment because volatility is going to be coming back with this election, and also sometime next year, early next year. We don't know what type of legislation is going on. We don't know what they're going to spend on. We don't know if they're going to have tax cuts or we're going to have tax hikes with Clinton. The craziness will continue regardless of who wins, and it will be fun if you're a trader or if you know how to invest wisely. So, anyways, guys, thanks for listening. Talk to you later. Bye.